All right. Good evening and welcome to our class for today. Earlier, I have shared my notes with you. So I would like you to come to the chat room to indicate if you can see my notes. So that's what I would use to know if you are hearing me. So let's start. If you can see my notes shared on the screen right now, come to the chat room and say so. All right. Thank you so much, Chiamaka. You can see my screen. All right. So let's start. This is performance management. And our topic for today is short-term decision-making techniques. Short-term decision-making techniques. At the end of this lecture, you will be able to analyze relevant costs to decide whether to make or buy a goods. And you also analyze relevant costs to price contracts. Okay, so now, one of the things that we learned last week was about marginal costing. And we said that marginal costing has one fundamental element, which is contribution. And so contribution plays a whole lot in management accounting. Now, why is contribution so important? It is because of decision making, and the contribution analysis help us to understand relevant costs. Now, relevant costs can be applied to both short-term and long-term decisions. Now, short-term decisions are these decisions where the financial consequences occur soon after the decision is taken. It occurs almost immediately, or if it takes a while, it is just a short time. For example, a short-term decision may result in an increase in profit. For example, you have an additional net cash inflow to increase the cash flow of your organization. It could lead to increase in profit for that month or for that year. So anything that the consequences or the decision is for just a year or so, it's called a short-term decision. Now, a long-term decision is where capital investment is required. I know capital investments are those investments which the enjoyment will last for over a year. And so it might span up to several years. So when you make a decision to buy an asset may last 4 years, 5 years, 10 years. So that decision to buy that asset is a long-term decision. So when we're talking about short-term decisions, we are talking about things that could, it immediately affects our P&L, so to speak. It is a short-term thing that will just affect our business. When we talk about long-term decisions, it is things that will affect our position statement of financial position, your assets, your liability, your capital. Okay, now the concept of relevant costs is the same for both short-term and long-term decisions. except that for long-term decisions, the time value of money should also be taken into consideration. For short-term decisions, because it is 1 year, you may not want to bother about time value of money. But for long-term decisions, you want to concern yourself with the time value of money. For example, you are buying an asset which will last up to 7 years. So you want to think, what is that more inflow I'm going to get in 7 years' time? What is the present value of it? So with that, you're talking about the time value of money. Okay. Now, examples of management decisions where relevant costing is used are one-off contract decisions. When we talk about one-off contract decisions, we mean decisions where management decide whether or not to undertake a contract for a fixed price. Now, if it is a one-off contract rather than a regular production work, this contract will be worthwhile if the extra revenue from the contract is higher than the relevant cost of doing the work, which will also include any opportunity costs. So examples of where relevant costing is applied is in one-off contract decisions, which we'll see in the course of this lecture. We also have the make or buy decisions. Then we have the shut down decisions and the joint product or further processing decisions. So these are some of the things we are going to see tonight. All right, so let's start with one of the management decision-making technique, the make or buy, also called the outsource decisions. What is a make or buy decision all about? Now, you agree with me that if you are into manufacturing of certain things, there are other people who could be doing the same thing. Let's take, for example, let me use, what will I use now? I've been using bread for a long time. Okay, now let me go to drinks. All right, let me just say, let's say Nigerian breweries, for example. Nigerian breweries, let's use one of their products. Let's say Star. You want to produce Star or Gulda. Now, you can produce the Star. The liquid is the main thing that you are after. So that's liquid. When people buy Star, they normally buy the liquid content. So you see, they will give you price for liquid content only. Now, your main stock in trade is the liquid content. You can't negotiate it. You can't outsource it. That is what gives you a niche. That is what you are producing. Now, when you produce this drink, this Star or your Gulda, okay? When you make that product, you will not just take it in cups to people's houses or to your customers to give them to drink. You must house it in a bottle, okay? So the bottle has to be produced. When the bottle is used to house the drink, it must be corked, must be covered. So the crown cork has to be produced. Also, you need to put them in crates. And so the crates will have to be produced. Now, you know that you need crates, bottles, crown cork, and the product itself. It is possible that as a producer, you can produce all of these, but it is also possible that you may not have time or to waste your time making the crates, making the bottles, or making a crank cork. So you may want to outsource. So what are some of those things that you need to consider before you make it yourself or you buy it because you have outsourced it? That is the make or buy decision. Now, if you can make the product, no, not the product now, the component, because the main product now, like using this star, is the drink, the liquid content. So you must be the one to make it. You can't outsource that. Components, let's say the crown cork or the bottle. What will influence your decision to either make it yourself or to buy? Now, if you want to, okay, now whether to make an item internally or to buy some from external supplier, or whether to do some work with internal resource. So it means if you have a kind of job to do, it may not be production, it's services. Let's say you are a tailor or a fashion designer, and you have plenty of jobs. You can decide to do the job internally, or you could contract some of these to outside source. Or maybe you are a teacher, you have several people to teach, and it could be that you could teach all of them, but there are some of them that the resources involved in teaching them is out of your control and you want to outsource it. The economic basis for the decision whether to make internally or to buy externally, which is outsourced production, should be based on relevant costs. Now, the preferred option from a financial point of view should be the one that lowers the relevant cost. So when you are making a decision to make or buy, the first consideration you will do is the financial consideration. So from a financial point of view, which decision will lead to a lower relevant cost? Now, after taking decision based on financial consideration, you may need to now put that financial consideration to further test by looking at non-financial considerations. We're going to be looking at financial point of view and also a non-financial point of view. First, let's talk about the financial point of view. A financial assessment of a make or buy decision typically involves comparison. So you're going to be comparing the cost that will be saved if the work is being outsourced. So it means that if you do not do it yourself, it means you will not go and buy materials, you will not spend certain amounts of money, you would have saved certain costs by giving it outside. Then you are going to also compare it with the incremental costs that will be incurred if you are going to outsource the work outside. So it means that you are going to be looking at how much am I saving? How much am I saving if I don't do this job? And how much am I going to be spending paying those people who are doing this job for me? So that's the incremental cost of the cost incurred. So if you are going to be saving more than spending, so it means that it is better to outsource that because you're going to save more outsourcing it. All right, so let's look at one example here to see how we can do a make or buy decision, how we can solve a make or buy decision. Now look at question number STD 01. STD means short-term decision and not the STD you may be thinking. So STD 0.01, make or buy decisions. Question: a company manufactures a component that is included in a final product. Okay, so remember how I use star as an example. So let's say it's the crank-cock that they mean here as a component. So just be thinking about the crank-cock or the bottle. So a company manufactures a component that is included in a final product that it also manufactures. So that final product is the whole liquid and everything that makes it a complete product. Management have identified an external supplier who will be willing to supply the component. So it means that perhaps somebody says he is going to supply the crank-cock. The variable cost of manufacturing the component internally is 100 naira, and the external supplier would be prepared to supply the components for 130 naira each. It has been estimated that cash savings on general overhead expenditure will be 48,000 naira each year if internal production is ended. What it means here is if they decide, let's say it's crank-cock now, if they decide that internal production of crank-cock will end, the overall general expenditure will reduce by 48,000. So that means they're going to save 48,000 naira a year if they stop doing this. So we've seen how much they're going to save in a year. Now the company needs 1,000 units of the component each year required. Should the company make or buy the component? I told you that in a make or buy decision like this, you're going to be comparing the cost you will save if you stop doing it internally. That means if you have sourced it out to external person, how much are you saving for doing that? Then you're going to compare it with how much you are going to spend on doing that external sourcing. So now look at the cost of purchasing the item externally. You see, they said they are prepared to give you at 130 naira, whereas you are going to make it at 100 naira. So it means that whether you give it out to them or not, you are going to incur at least 100 naira. So whether you do it yourself or you give it out to them, 100 naira must be incurred. But because you are giving it out to them, you are incurring extra 30 naira. If you have not given it out to them, you will have been doing it for 100 naira. So 30 naira is the extra cost of doing this external supply, external sourcing. So 30 naira is the extra cost you're making on each product, each component, rather. Now we have 1,000 components each year because the company needs 1,000 units and they are going to have 1,000 components using it. So if you're going to spend 30 naira extra on each component, that means extra cost will be 30 naira multiplied by 1,000, which is 30,000 naira. Now that is an extra cost. So that's why you see it in bracket here. Cost in this instance is a negative figure. Money is going out of you. So you put it in brackets. How much are you going to save? So that's money coming to you. It's like a revenue. The company is going to save 48,000 naira a year if they stop doing it internally and they give it to outside consultants. So the extra savings is 48,000. And so when you have 48,000 and you spend 30,000 naira out of the 48 which you have saved, it means the net benefit to you is 18,000 naira. So you see, if you have not stopped doing that thing internally, you won't spend this 30,000 naira. You won't spend 30,000 naira. You would rather more. 48,000 naira to you will be lost. So since the net benefit of stopping it is 18,000 naira, it means, conclusion, the company would increase its profit by purchasing externally instead of making the item in-house. Okay, so that's on a financial point of view. The recommendation on financial consideration is therefore to buy or outsource production of that component externally and not to make it internally. Now that is financial consideration. I said before, you are going to be putting that financial consideration to test to see whether overall you will still hold to this conclusion, or you may want to have a shift in thinking. We're going to look at non-financial consideration in a while. But let's talk more now about make or buy decisions when there is a scarce resources. Now we are still looking at financial consideration because I said that is what you consider first to see if it is viable. Now, it is when you have looked at financial consideration and you say, oh, it's not viable, you may not want to talk about the non-financial consideration. But when you look at the financial consideration and you see that, oh, it's worth doing, oh, you hold on, you match the brakes. What about non-financial consideration? That is when you have put them into perspective. Now, in example one, which we did, we saw that we didn't see any scarce resource. But in example two, which we are going to do in a moment, we're going to be seeing scarce resource. It means when there is a scarce resource, all the available production is competing for that scarce resource. And so when you have a scarce resource, you may want to think twice. All right, a different situation arises when an entity is operating at full capacity. When we say full capacity, we mean here that you don't have time to rest. You come to work 8 o'clock and you're closing by 5 o'clock. You are always seen working. There is no time for joke, no time to go to the internet, no time to go to Facebook or WhatsApp. You are working. The only time that you are not seen working is perhaps if there is a machine breakdown or when you are at your break time. So now that is full capacity. Now, if the company is operating at full capacity and has the opportunity to outsource some production in order to overcome the restriction on its output and sales, the company may take that option. So it means that if you are having a scarce resource, or if you are working at full capacity, let's say, for example, you are producing, I'll be using Star in this class today. Let's say you are producing Star Lager beer, and your capacity is 1,000 crates, and you have an order for 1,500 crates. Of course, you know that you cannot produce the whole 1,500 because already your full capacity is 1,000. What do? You'll be forced to outsource some of the components or some of the production of this requirement to outsiders. Okay, so let's look at this example here. For example, a company might have a restriction, or at least in the short term, on machine capacity or on the availability of skilled labor. It can seek to overcome this problem by outsourcing some work to an external supplier who makes similar products and which has some spare machine time or labor capacity. We're going to see that in a moment in a question. In this type of situation, a relevant costing approach is to assume that the entity will seek to maximize its profits and therefore outsource some of the work, provided that profits will be increased as a consequence. The decision is about which items to outsource and which items to retain in-house. The profit maximizing decision is to outsource those items where the cost of outsourcing will be the least. Now, look at it. If you want to outsource something, you want to give out people to do the work for you, you will rather give out jobs that you will spend the least. And you will rather take in jobs where if you had outsourced it, you will pay the most. So the one that you will pay the most, you rather do it so that you can save the most. If you give out the jobs that you spend the least, rather than doing it, it means the one you would have saved, the least amount you would have saved, you spent it. So that's okay. So how do you do this? You have to identify the least cost outsourcing arrangement. So to identify the least cost outsourcing arrangement, it is necessary to compare the additional costs of outsourcing production of an item with the amount of the scarce resource that will be needed to make the item in-house. Okay, so let's look at this illustration. STD02, make or buy decisions with scarce resources. Now, we are going to be identifying what is the scarce resource. So the first thing here is to identify that scarce resource. A contract cleaning company provides 3 services: daily office cleaning, intensive cleaning of office space, and minor repairs. However, it has insufficient resources to do all the work available, and wishes to use a subcontractor to take on some of the job or some of the work. Information relating to the different type of work is as follows. Now, if you look at the column headings here, you will see average labor hours per job. And if you look at the column down the line, you see that daily office cleaning, it takes you 4 hours. 4 hours to do one job. So to clean an office daily will take you 4 hours. If you're going to do intensive cleaning, takes you 3 hours. Minor repair, one job takes you 3 hours. Now look at the budgeted jobs. It means that for the period in review, you'll be having 1,500 daily office cleaning. And so it means that if you're going to do them 4 hours per job, it means 6,000 hours will be used. Intensive cleaning, 6 hours for one job times 400 jobs, you have 2,400. Now when you look at minor repairs, multiply 3 by 640. Now you know the number of hours all of these will take you. Now look at the variable cost of doing the job. So when we say variable cost, it is the cost to the entity. The cost to the entity. It means here that to do the job, the entity would have spent 600 naira, 1,080, and 560. But now, if you want to subcontract the job, the subcontractor is going to take 800, 1,500, and 1,000 naira. Now, clearly, the subcontractor's quote is higher than the variable costs. So it means that the company can do it. The company will be saving themselves money if they do the job, because it is cheaper to do the job by themselves than to give subcontract. But there is a problem. Now the problem is there are 8,000 labor hours available. Okay, so if there are 8,000 labor hours available, let's take a look at how many hours will all these jobs take. Daily office cleaning is going to take you 6,000 hours. That means you'll be left with 2,000 hours. Intensive cleaning already is going to give you 2,400. So you see, it's 400 off the 8,000. Then when you look at the other one of 360 and 3 times 640, is going to give you 1,920. So you have 1,920 plus 400, an extra 2,320 hours off your 8,000 hours. So your 8,000 hours is the full capacity that you can work, the labor hours available. And there is no way you can take a 10,320 hours job and do it in 8,000 hours. That means you have got to subcontract some of these jobs if you must meet your targets. So that the point is, which of these jobs are you going to subcontract? And how many will you subcontract? Now it tells you that the scarce resource is labor hours. You have to do as much as your 8,000 hours can carry, and the extra, you give it out. What is the technique to know which one to subcontract and which one to do? We said before, the point here is give out those jobs that you will spend the least. That's the trick here. Give out those jobs that you will spend the least, and take on those jobs that you will save the most. So if you are spending least, it means you'll be saving least. If you are spending the most, it means you could have saved the most. So the point here is give out jobs that the cost of spending is at ascending order. So the one you spend least, okay, sorry, is at descending, okay, no. Give out in ascending order of least cost. So the one you send, you spend the least. That is the first job you are going to give, followed by the one that is following it that you will spend a little bit more, a little bit more. That is how you are going to do it. So let's see the technique of doing it here. Now, look at the problem here is to decide which of them to outsource. So there is what they call ranking. It is this ranking that will help you to know which one you are going to do. Now, let's see. If you are to do the job, look at the columns here. The columns we're having the jobs there: daily office cleaning, intensive cleaning, minor repairs. So let's analyze. If you are to do the job yourself, you are going to be spending a variable cost of 600, 1,080, and 560. If you are to subcontract the job, you'll be spending more. So how much is the extra that you will be spending? So there's the extra cost of outsourcing. So for daily cleaning is 200 naira. For intensive cleaning is 420. For minor repairs is 440. And that's not all. Now, we are told that, let's get to page 3 here. We are told that for daily office cleaning, the average job is 4 hours. So it means that if you are to spend extra 200 naira for one job, and that job is supposed to last you 4 hours, if you give out this extra 200 naira, you saved yourself 4 hours. So what is the extra cost per 1 hour saved? So if this 200 naira extra cost you're spending is for 4 hours, now what is the cost for 1 hour? You simply divide 200 by 4. It means for every 1 hour that you save, the extra costs that you are spending is 50 naira. So you are spending 50 naira per hour saved. So 50 naira extra cost for 1 hour you save. Using the same analysis, you have 70 naira for every 1 hour saved. And you have 140 naira for every 1 hour saved. Now, if you want to outsource, you will give out the one that you spend the least extra cost per hour. So it means you are going to be spending 50 naira per hour saved. That's the one you will give first. Then if that is not enough, you can now go to 70 naira cost, extra cost per hour. Then of course, 140 naira is the extra cost you are willing to spend per hour. So for outsourcing, you will give it like that: 50 naira first, then 70 naira, then 140. Then you will now flip the coin the other way to do the work yourself. If you are to do the work yourself, you take the work that you will spend the most. So this is extra cost that you are going to be saving in 1 hour. You rather do this one first and incur and save yourself spending this 140. Then if your capacity can carry you, you take 70 naira job and all that. So outsource priority, you see that the ones that you are spending least is the one you are giving out first. The one that you would have been spending most, that is the one you are undertaking first, so that you don't end up giving it out. All right, now the company can do all 3 jobs more cheaply with their own staff than having to hire a subcontractor. However, provided that it earns more than 800 naira for daily office cleaning, 1,500 for an intensive cleaning job, and 1,000 naira for a minor repair job, it is profitable to use a subcontractor to make up the shortfall in the in-house resource. Let's see now the optimal plan. Now, we've seen that the company is going to do, what's the name here? It's going to do minor repairs first, followed by intensive cleaning, and followed by daily office cleaning. So the company will want to take its own first, then the remainder is what it will outsource. So the company will not first outsource. Although you see priority for outsourcing is done first, the company will first take its own job to fill their 8,000 hours. Then the remainder, I will say the crumbs, is what they will give it out, because it is far cheaper to do it in-house. So let them take the capacity they can, and the one that they can, they have seen from where they will give it out. So let's see how it goes. The optimal production is to start with minor repairs. Why? Because that is the priority for in-house job. So minor repairs, the total job for minor repairs, let's see. Okay, sorry, let's leave here. Minor repairs, if you look at minor repairs, 640 jobs. And if you take 3 hours per job, so 3 times 640, that gives you 1,920 hours. So that is this 1,920 hours we have here. 1,920 hours. The budgeted jobs is 640, and it will give you 920 hours. So what it means is that if we are going to do all these jobs, 640, what is the variable cost to doing them? 560. So what you do here is 560 naira for one job. Since you are doing the whole 640, when you times it by 640, you have 358,400 as a total variable cost you are going to spend. Now, 1,920 hours is not up to 8,000 hours. So you still have more jobs to do. You go to the second one in your plan. The second one here is that's the second one here. What is that? It's intensive cleaning. So intensive cleaning is the second one. So what's the intensive cleaning? You need to do 6 hours per job, and there are 400 hours, 400 jobs. So 6 times 400 gives you 2,400 hours. That is this 2,400 hours. And so, since you are doing 400 jobs and you have concluded that you do the whole 400, so 400 times your variable cost of 1,080, that gives you 432,000, which is what we have here. Okay, now that you've taken minor repairs, intensive cleaning, you've taken 2 out of those 3 jobs. Now we are at the third one, and we know that you cannot do everything because we've seen that there is a shortfall of 2,300 and something hours. So it means that the remainder that would make it 8,000 hours is what you will do. So how do we get that balancing figure? All we'll do is we'll look for the minor repairs of 1,920 hours, add it to the 2,400 hours, and it gives you 4,320. Remove 4,320 from 8,000, you are left with 3,680. It means that that is the job you will do. So if you have insisted that you want to do the daily office cleaning, which is 4 hours multiplied by 1.5, to take you 6,000 hours. So you can't do the whole 6,000. So you are left in doing daily cleaning of office that would take up to 3,680. So you ask yourself, how many jobs will you do that will give you this amount, 3,680? So all you need to do is 3,680 is the total hours you want to spend. If you are taking it 4 hours per job, 4 hours per job, how many jobs will you do? So you divide 3,680 by 4, and that gives you 920 jobs. So out of this 1,500, you are taking 920. And what that means is that if you take 920, the remainder from 1.5 is going to be 580. So 580 will be what you are subcontracting. You are doing 920 yourself and you are subcontracting 580. The extra cost to you is 50 naira. Okay, so what is the variable cost here? If you are doing these 920 jobs yourself, variable cost is 600 naira. 600 times 920 gives you 552,000. Let me confirm with my calculator. 920 times 600, yes, 552,000. So for in-house, if you add up all these variable costs here, you are going to get 1,342,400 for using the 8,000 hours. You will be spending that amount. Now that's your variable costs, and that's not all. The subcontractor, you are going to give him 580 naira and 580 jobs, and he's quoting that he's going to take 800 naira. So what you do is 580 multiplied by 800 naira, that will give you 464,000. So that is what you are going to spend on the subcontractor. When you add this to what you are going to spend in-house, you are spending a total variable cost of 1,806,400. Now, that is what the question is asking you, that how many will you subcontract? How many will you do in-house? What is your total variable cost on that? So you see here that the office cleaning job will be outsourced, and the 1,500 can be reached if the company do 920 and outsource 580. So that's so much for that question number 2 on the scarce resource. So we are going to take another question on scarce resource and see how we can understand that concept more fully. Just a moment. Okay. Example STD03. We are still on make or buy decisions with scarce resource. A company makes 4 products, W, X, Y, and Z. All 4 products are made on the same machines. And the machine capacity for the year at Wombats factory is 3,500 hours. So without reading more, I am guessing that labor hours or machine hours will be the scarce resource. And so they are going to be competing for machine capacity. The company is able to obtain any of these products in unlimited quantities from a subcontractor. So it means that since it's getting unlimited quantity from a subcontractor, any shortfall from what they are going to produce within that 3,500 hours, they are going to outsource it. Budgeted data is as follows. Now look at the products W, X, Y, and Z, the annual sales demand. So this is what they have been demanded from their customers. 4,000, 6,000, 3,000, 5,000. Look at their selling prices. Look at their variable costs per unit in-house manufacture. Then look at the cost of external purchase of these. So you can see clearly that the external price is higher than the variable cost of doing it. So it means that it's going to be cheaper doing it yourself. The only reason why you are now outsourcing is because of scarce resource. Now look at the machine hours per unit. In-house, it means that for every 1 unit of W, it's going to spend 0.25 hours. 0.25 hours is like 15 minutes. So it's just like saying 15 minutes. All right. Now, for any of X is producing, is spending, did I say 0.25? Yes, it's 15 minutes. Sorry, let me see. 60 hours and 0.25. Yes, it's 15 minutes. Then for every X is going to produce, it's taking 0.5 hours. 0.5 hours is like 30 minutes to make 1 unit of X. Then for every Y it's going to produce, is going to use 0.3 hours, which is like 18 minutes. Then for every Z is going to make, is using like 0.4 hours, which is like 24 minutes. So you may leave it in these figures here. Excuse me. You may also want to convert to minutes, whichever makes you feel good. Required. Which items should be produced in-house and which items should be outsourced? Calculate the total cost associated with the optimal plan. Now, from a financial point of view, the total cost associated with the optimal plan is going to be the lowest cost possible because you have used this decision technique that accommodates scarce resource and you have used it well. All right, so let's look at the solution to this problem. Okay, so solution, the variable cost for making each product is lower than the variable cost of purchasing the product externally. Therefore, profit will be maximized by making all the products in-house rather than purchasing them externally. But we have a constraint of machine hours. So that's the only reason you are externally sourcing some of these. Now, let's use the same technique we used in the previous question. The variable cost of making these 4 products in-house, 50 naira, 70 naira, 60 naira, 70 naira. Now, what is the external cost of purchasing these items? 80 naira, 118, 105, and 110. So it means that the extra costs you are going to spend, because you must spend your variable cost, quite all right. So, but if you have to purchase it externally, you're going to spend extra. What is that extra cost you're spending? For Y, for W is 30 naira, for X is 48 naira, for Y is 45 naira, and for Z is 40 naira. Now that you know the extra cost you are spending, bring the hours that is required for doing those jobs. So the number of hours to do the jobs is the number of hours you are going to save if you don't do the job. So it means here that if you are taking 0.25 hours, which is like 15 minutes to do W, and you take 0.5, 0.3, or 0.4 to do the others, when you divide it by the extra cost saved, it means that for every 1 hour of doing this job, W, you will be spending 120. Whereas for X, for every 1 hour, you'll be spending extra cost of 96. And for every 1 hour for outsourcing Y, yes, you're saving 1 hour, but you're spending 150. Then coming to Z, if you have to save 1 hour, you're spending 100. So which one of them is the one you will spend the least for 1 hour? Is X. So X is the one you spend the least, and so that's the one you will quickly give out, followed by Z, then followed by W, then by Y. Then you flip the coin the other way around. For in-house, the one that you are going to spend most is one you are going to do first, followed by, that is Y, followed by W, then by Z, then by X. So that's how we are going to fashion out our production plan. And look at the production plan we've set up here. We want to achieve 3,500 hours. So we are going to do Y first. Now, according to the question, Y, our demand for Y is 3, okay? Our demand for Y is 3,000. But what is the machine hours available? So it means that if you have 0.3 hours, which I say is about 18 minutes, 0.3 hours to do one job for Y, and you have 3,000 jobs in Y. So you multiply it by 3,000, you're having 900 hours to be used to do all of Y. So that's this 900 hours we have here. And the unit is 3,000. In the same vein, so 900 is short, it's not up to 3,500. So we move to W. W is the second option for us. We have 4,000 units and we are taking 0.25 to do each. So 4,000 multiplied by 0.25, That gives you 1,000. So you have 1,000 hours plus your 900, you would have gotten 1,900, which is still less than 3.5. And so this your 4,000 units will still be used. Variable cost for that 4,000 units, variable cost here is 50. So 4,000 times 50, that gives you 200,000, which is what we got here. The same thing we did the up one here, 3,000 units multiplied by 60 naira, which is going to give me 1,180 naira, 80,000 naira. Now let's go to Z, because Z is a third thing we are supposed to do. Z. So Z is the third thing we are going to do. How many of Z do we have? We have 5,000 units of Z. Okay. Now, how many hours does it take to do one? 0.4. So we have 0.4 multiplied by 5,000. Wow, that gives us 2,000. And remember, we already have 1,900. So if you add 2,000 to 1,900, we will be having 3,900. Remember, our factory hours is limited to 3,500. So by doing Z, we'll be overshooting, we'll be cramped for time. That means we will not do all of Z. It means we must allocate or outsource some part of Z. So what do we do? How many of Z can we do? We already have 1,900 hours already used by Y and W. So let's minus that 1,900 from 3,500. We are left with 1,600 hours. So that's what we are going to use to do Z, 1,600. So how many of Z can we do in 1,600? So what we'll do, we will divide 1,600 by 0.4. And that will give us 4,000. So it means out of this 5,000, we are going to do 4,000 ourselves. So you see it here, we do 4,000 ourselves, and we are outsourcing 1,000 to the outsource unit. So we are spending 16 hours, which makes it 3,005. So if we are going to do 4,000 units, and we are going to spend 17 naira per unit, so we are going to be spending 280,000 naira to do Z ourselves. Now let's go to the outsource. Outsource here, if you look at it, I'm not concerned with their machine hours because that's not our business. We are not trying to look at their scarce resource. We said in the question that there are outsourcing companies that can do it unlimited number. So it's possible we can outsource to 2, 3, 4, 5 people, who knows? But the point is we are outsourcing 1,000. And how much are we going to spend to outsource that 1,000? We're going to spend 110 naira. So 1,000 multiplied by 110, that gives you 110,000 naira. So that's how we got here. And then we are left with X. We can no longer take anything after we've taken 4,000 units of Z. That means we will never touch X. It means the whole of X, which is 6,000, will be outsourced. The whole X will be outsourced because we are going to spend the least extra costs. And now what is the total cost for X we are going to be spending? 118 naira. 118 multiplied by 6,000, we are going to be spending 708,000 naira. It may seem here that we are spending 780,000, which is higher than all the others. But if you look at it from the scarce resource point of view, if we have to undertake X, thinking that we are saving 780 naira, you'll be doing yourself more harm because you'll be spending extra 120 hours for you think you are saving extra 120 hours. You think you are sorry, you think X, what is X here? You think you're saving extra 96 naira for doing the job. But for saving that, the savings, that cost that you are saving will be smaller than the cost you are going to spend. So you see, you'll be thinking that you are saving 708 naira, but you'll be spending more doing X. So it's good you outsource it based on this number of hours. So you see, if you do it any other way, your total variable cost will be higher than this. So in the optimal plan, your variable cost that you have, total variable cost, is the cheapest so far. If you are to do it any other way, that's an assignment to you. Now, instead of outsourcing Z, do the whole of Z. And if you do the whole of Z, how many hours is it going to take you? How many hours is it going to take you? Do the whole of Z, 5,000 multiplied by 0.4, it's going to take you 2,000. And assuming you do the whole of Z and you start doing the next one, you do Y, and you now do part of W and outsource the whole of Z, you are going to be spending more variable costs. Any other method will lead to a higher variable cost. Only this will give you the lowest variable cost. So that's why you are going to do this. Now we've come to the non-financial consideration, which we talk about. So when we've discussed the financial consideration, you've seen which one is cheaper to do, which one is better for us. Non-financial consideration will be used to judge if we are really going to do that. When relevant costs are used to make a decision, it is assumed that the decision should be based on financial consideration and whether the decision will add to the profit or cash flow. In reality, managers are likely to think about non-financial issues as well as financial issues when they are making the decisions. The non-financial consideration in any decision will depend on the circumstances and will vary from one decision to another. Non-financial considerations can influence a decision. And so in your exam, you will be prepared to identify relevant non-financial issues in a particular situation and discuss their potential implication. Now, some of the non-financial consideration that would be considered in a make or buy decision include the following. When work is outsourced, now the entity will lose some control over that work that has been outsourced. So it means that it will rely on the external supplier to produce and supply the outsourced items. They cannot have control over that. They will lose some control. And that will bring some risk. There's a risk that the standard quality will be lowered. The quality will be lowered because these outsourcing people, they want to make more profit. They don't care about your standard. And so they might lower the standard a little and make extra money. So there is a possibility that that could happen. Also, there is a possibility that they may fail to meet your delivery dates and schedule. So, okay, so when they fail to meet your production schedule, it will mean loss of revenue for you. Also, the entity will lose some flexibility. If it needs to increase or reduce supply of outsourced item at short notice, it may be unable to do it because of the terms of agreement. Sometimes they may want to produce, maybe your terms of agreement may be that give us 50,000 units every day. But something could happen and they may want you to produce 70,000 that day. And you're supposed to give them enough notice, and you cannot do that because you have outsourced. But if it was to be in-house, you just tell everybody, all right, please stop production of all other things. Let's focus until we get this number we want. All right, so you lose some flexibility. Also, a decision to outsource may have implications for employment within the entity. And it will make some staff to be redundant because some things that you would have allowed the staff to do in-house, you've given it out to others, and so they may not have job to do. This will have cost implication and could adversely affect relationship between management and their employees. It might be appropriate to think about the longer term consequence of a decision to outsource work. Now, what might happen if the entity changes its mind at some point in time in the future and decides to bring the work back in-house? What will happen? What is the consequence for doing that? And what if it decides that, okay, I don't need this supplier, I want to give the work to a different supplier? The problem might be that taking the work from the initial external provider and placing it somewhere else may not be easy in practice, since the external supplier might not be cooperative in helping you to remove the work you've given to him. And also, they may have understand your process and some other things. And now taking it to another people, you may have to start learning them. You start seeing some other traits that you might tell yourself, oh, if I had known, I would have stuck with my previous supplier. These are some of the things that the problems that could arise if you decide to use external supplier. Now, there are some things that they say these non-financial factors listed above are all reasons against using outsourcing external suppliers. There might also be non-financial benefits from giving out your job to external suppliers. For example, if the work that is outsourced is not specialized, it's not something that you are specialized, or is outside the entity's main area of expertise. Now, outsourcing the job will enable the management to focus more attention on those aspects of their operation that the entity can do best. they have to focus more attention on where they are experts and give out those ones that is just secondary. That's not their main focus, so that they can have more time to focus on what's their main thing. For example, it could be argued that activities such as the management of an entity's fleet of delivery vehicles or the monthly payroll could be outsourced because the entity has no special expertise in this area. So it means that if you don't have special expertise in your human resource management, or you could even say, let's use the star that we'll be using as our example. You could outsource the crown cock production so that you can focus more time on doing the liquid content. Now, external supplier, on the other hand, may have specialist expertise or knowledge. And so when you outsource it to them, you get the benefit from the expertise knowledge, and you are therefore doing your job more efficiently and effectively. For example, a company might outsource all of its IT support to some external company because it cannot recruit and start training IT specialists and be paying them every month huge amounts of money. So it might just outsource this to a company for a small fee. So you see, when you're looking at the positive side, you may have to also balance it with the negative side. Or you're looking at the negative side, you balance it with the positive side. So when you're looking at the financial consideration, and the examiner asks you what are the non-financial factors to consider, you have to look at some of all of these and give it to them. Now we have one-off contract decisions. Okay, what is one-off contract decisions? Management might have an opportunity to carry out a contract or job for a customer where the job is once only and may likely not be repeated in the future. So it's just one-off, once in a blue moon. The decision, therefore, is whether to agree to do this one-off job at a price offered by the customer, or decide a selling price at which an incremental profit will be made. Now, if it is a one-off contract, which is not a regular production work, it will be worthwhile to undertake the contract if the extra revenue from that contract is higher than the relevant cost of doing the job. So that is what is called relevant costing decision in one-off contract. So when you're looking at relevant cost of doing the job, you also have to include opportunity cost. What is opportunity cost? Opportunity cost here means the cost that, or the benefit that you would have gained by doing something else, but now you've stopped that thing that you would have done, and so you lose that benefit. Why did you stop that thing you would have done? Because you want to do this one-off contract. So this one-off contract will make you to stop doing something, stop benefiting from something, and you have to include that cost. So you see, like part of the charges I charge you for this extra class is opportunity cost, because I would have stopped doing something by this time that will be beneficial to me financially. And so I would say, okay, if I have to stop that, I'm not going to get this money. I'm going to transfer that cost to this your job. Okay, so that's how it works. The incremental profit from the one-off contract is the revenue that will be obtained minus the relevant cost. So we are going to see a question that will help us. One-off contract decision might occur when a company has spare capacity. So you now see here, we mentioned scarce resources in make or buy decisions. Now, it means that the company do not have spare capacity. Now, when the company has a spare capacity, it means that the company has some idle time and they can decide to use their idle time to do this one-off contract. Now, if they have an idle time, that means there is nothing like opportunity cost here. But when the company is moving at a full capacity and you want to take time out of that full capacity to do a one-off contract, then we talk about opportunity cost coming into play. This type of analysis should not be applied to most decisions. However, because a company must earn sufficient profit in total to cover its fixed cost and a profit and make a profit, relevant costs do not help management to decide what size of the profit margin should be in order to ensure that the company makes an overall profit from all of these activities. Okay, so this is just some comments here. Let's go now to the nitty-gritty, the main thing here in this special contract, one-off contract. Now let's look at this example. Example STD04. Contractor Limited is deciding whether or not to proceed with a one-off special contract for which it will receive a once-off payment of 200,000 naira. So this is what is the revenue is going to get. So now this revenue will now be used to compare with the cost to see if it is worthwhile. Details of relevant costs are: 1, or A, the special contract requires 200 hours of labor at 600 naira per hour. Employees possessing the necessary skills are already employed by the contractor limited, but are currently idle due to a recent turndown in business. Now, as I'm reading this one by one, I'll be attacking it immediately. So what do we say when employees are already in permanent employment by the contractor? Now, this one will make us to learn relevant costing as a topic after this, because we're going to build up on this. So now I'm telling you a little about relevant cost, but we'll talk more about it in the next class. Okay, so I'll be taking the answer for that part immediately. So let's look at the comment for that. Let's look at the comments. Now, the relevant cost of labor is 0, as no extra cost will be incurred as a result of this contract. So it means that whenever people are already in permanent employment, you don't need to pay them at all this 600 naira per hour for the 200 hours, because by employing them as permanent workers, you have already paid them. You have paid them, and moreover, they are idle. You've paid them for their useful time. You've paid them for their idle time. So you can always tell them to use their idle time, which you have already paid them for, to do the contract. So you don't need to pay them this, you don't need to incur these costs. So here, the relevant cost of labor is 0. Let's read on. Materials X and Y will be used. Now let's look at what is required in X. 100 tons of material X will be needed, and sufficient material is in inventory as the material is in common use by the company. Now, two things here. You need 100 tons and it is available. So because it is available, you'll be tempted to take it and use. And so you'll be asking yourself, I have it now. Do I need to buy it? No, I already have it. But there's another thing. It is in common use by the company. So it means that if it is in common use by the company, the company will need it. So you are not taking 100 tons to do a special contract. Why not go and buy what you need for that special contract and leave what the company will commonly use? So it means that if you are taking what the company will use, you must replace it. So the original cost of material in inventory was 150. Now this original cost is not important because if you are to use this 100 tons, when you go to the market to replace it, you cannot get it at 150 any longer. But it will now cost 180 naira to replace if it is being used in this contract. So what you do now is you multiply 100 tons by 180, and that gives you 18,000. I think that is what we did here. That is what we did here. All right. So let's read on for Y. Material Y is in inventory as a result of over purchasing. So that means they spent more money, they bought and over purchased Y. Okay, so that means it is available in store. Can you use it? Yes. The original cost of material Y was 50,000 naira. So all of Y is 50,000. So is that the cost you're going to use? Now, unfortunately, material Y is toxic. When we say something is toxic, it means it's poisonous. It means it should not stay long. And remember, they have over purchased. So it means that the company will take what it needs and there will be an extra. And so we say it has been over purchased. And here the question says, and if it is not used in this contract, the company will now go and pay 24,000 naira to get it disposed. So you see, it cost us 50,000 naira now. It cost us 50,000 naira when we bought it, but the company has no other use for it. So it's just there. It's just there. So if you don't use it, it's not going to, it's not valuable to the company. It is toxic. And so since it is not valuable to the company, it's as good as saying the value is zero. But now something is happening here. You have to pay 24,000 to have it disposed. You can save that disposal cost by using that material for the contract. And so 24,000 naira saved will be the value for material Y. And that is what we did here. So the value of material Y is now 24,000 naira, which we are saving from the disposal of material. Let's read on. The contract will require the use of a storage unit for 3 months. Of course, storage unit you need to pay. Contractor is committed to rent the unit for 1 year at a rental of 8,000 naira per month. So committed, it means you have no other choice. You must pay this 8,000 naira. You must rent this storage for 8,000 naira per month. Okay, so you are committed to that. You have already signed a contract that you are to pay. You are to rent this 8,000 naira per month. Now the unit, the storage unit, is not in use at present. Yes, you have a contract which you are committed that you have to rent 8,000 naira per month, but for now, nobody is using it. However, a neighboring business has recently approached Contractor Limited, offering to rent the units from them for 11,000 naira per month. So what do you do now? The contract requires storage for 3 months. You have a contract to rent it for a year, 8,000 naira. Right now, the people who are into contract with you are not using it at the present. Somebody has approached you to pay you 11,000 naira per month. Now you want to use it. It means that you have to charge 11,000 naira as opportunity cost for not accepting the neighbor's contract or using it for the storage material, for storing of the contracts projects. And then that means that 11,000 naira minus 8,000 naira is 3,000 naira extra savings that you will get. So you see here, 3 months. So what is going to cost you here is 3 months multiplied by 11,000 naira per month, which is 33,000 naira. Now, this 33,000 naira is opportunity cost because you will forego taking the neighbor's proposal of 11,000 naira because you want to use it to store for your project. And so it means the storage unit is only valued at that opportunity cost of 33,000 naira. Okay, so we go to the D part. Overhead are absorbed at 750 naira per labor hours, which consists of 500 naira for fixed overhead and 250 for variable. Total fixed cost overhead are not expected to increase as a result of the contract. Now, something about fixed cost is whether you produce nothing, you produce little, you produce at capacity, your fixed cost remains the same. This question says your fixed cost is not going to increase as a result of this contract. You have already sought out your fixed cost from your regular supply, your regular product. So the fixed cost element does not feature, does not matter. So it's irrelevant cost. So the 500 naira for fixed cost is not relevant. But the relevant cost here is the variable cost because it is varying according to the number of units. So we said in our first class that fixed costs are unavoidable costs. So you cannot avoid this 500 naira, you must spend it. Whether you do the contract or not, you must spend it. And I said before, the 500 naira would have been taken care of by your normal jobs. But now, the variable costs are avoidable. You could avoid the 250 naira per unit by not taking the contract. But now you've taken the contract, you will incur it. So it means that your variable cost will be 250 naira per unit, per labor hour. So all you need to do is 250 naira per hour times 200 hours. Where did we get the 200 hours? Labor hours. We were told the special contract requires 200 hours. So you multiply by 250, that gives you 50,000. Is it 50,000? Yes, it's 50,000. A trainee accountant has performed the calculation, which shows that the contract costs will be 359,000 to deliver, and concluded that since the contractor is saying he's going to pay 200,000 to us, and the trainee is saying, if you pay us 200,000 and we are spending 359,000, then we'll be making a loss. So please don't accept. And I look at what the trainee did. The trainee now said, labor will be 200 hours, yes, multiplied by the 600 naira per labor. And the trainee got 120,000 naira here. But what we did, we said it is zero. Remember how we said it is zero? Because there's idle time, we've already spent the money on them. The trainee now said material Y is 100 tons, multiplied by the 150 naira X, material X, by the 150 naira that it was originally bought, and they got 15,000. But here, we did something else and we got 18,000. We used the current market price to get 18,000. Then for material Y, the trainee said, since it originally cost us 50,000 naira, whether we have no use for it or not, since we are using it for the contract, it means we must apportion 50,000 naira to it. But our relevant costing technique said, no, we will take 24,000 naira, which is the cost of disposal. And now we are not even adding it. We are saving 24,000 naira. It means we would have spent 24,000 naira, but we are gaining it back. So it's like a revenue to us. So all these are costs. 24,000 is like a revenue to us. So you see the technique here. Then the man is saying the storage is for 3 months. And since we have a contract for renting it at 8,000 naira, we now did 8 times 3, 24. But we said, no, we'll use 3 times 11. Opportunity cost, which is 33. Then for overheads, the man decided to put both the fixed and the variable cost together, 750 multiplied by 200, and got 150. And we said, no, we are going to use just the variable cost, and we did and got 50. So while he is getting 359, we are getting 82,000. And so if our relevant cost is 82,000 and he's offering to give us 200,000, of course, the revenue we are getting is higher than the relevant cost. It means we should accept the contract instead of following the trainee that says we should reject the contract on financial grounds. They said, calculate the relevant cost, which we've done, and advise whether the contract should be accepted or not on financial grounds. Underlying financial grounds, it means we must only think in terms of numbers, in terms of finance. Here, do not talk about non-financial consideration. If they ask you non-financial consideration, that's when you start explaining. Okay, so far so good. We have been able to learn about relevant costs. The technique of relevant cost is being applied here. when we are deciding to make or buy goods. And we said the relevant cost of making, which is the variable cost, is being compared to the relevant cost of buying, which is the purchase price. Whichever is smaller, whichever cost is smaller is what we are going to go by. Then we looked at relevant costs in scarce resource. And we said we are going to look at how much extra costs we are going to make, we are going to spend if we outsource it. Then we are going to divide it with the number of hours we usually do the job, which we are saving because we are subcontracting it, to get what we call extra costs per 1 hour saved. So we're going to compare the extra cost for all the units per 1 hour saved, and we'll look at the smallest extra cost. That is what we are going to outsource first, followed by the next smaller one, like that, until the higher one. Then flip the coin the other way. The highest extra cost saved is what the highest extra cost per 1 hour saved is what we are going to do. So we are doing our ranking internally from descending order, from the highest to the lowest. So the highest is ranked 1 for us, the lowest is ranked last. For the priority to give it out, we are using ascending order. The smallest one is ranked higher, number 1, and the next smaller one, the next higher one, like that. So, like I said, the next class, we are going to be looking at relevant costing techniques proper. So come prepared on Wednesday, the next class, when we'll be doing that. So if you have any question on this topic, and I will also advise too that you go to the past question, look at icon past questions and some other past questions or textbook that you can lay your hands on, and look at make or buy, and also play with some relevant costs, because all of these will feature this week and perhaps next week in our discussion. So thank you so much for coming to class today, and thank you for the cooperation you've given so far. If you have any question, feel free to WhatsApp me or send me a voice note, and I'll be sure to provide guidance for you. So have a nice day and enjoy the rest of your evening.